Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, let's dive right into DataVault AI, ticker DVLT. This stock is, well, it's one of the most volatile and, frankly, financially engineered situations we've seen in the small cap space this year. The company's done a radical pivot, shifting completely away from its legacy, WISA wireless audio business to focus on data financialization and RWA tokenization.
And that pivot, ambitious as it is, it immediately throws up some huge red flags just because of the mechanics of how they did it. We have to set the context here. The stock is trading in that tight, 65 to 75 cent range. That's the base for this whole 5x potential thesis. That's targeting 350 or higher, but that whole idea is getting crushed by, immediate and massive institutional selling.
Right. And to set the stage with the most recent action, between December 26th and 30th of last year, 2025, we saw this huge concentrated selling pressure. Skylex liquidated over 20.6 million shares at an average price of around 61 cents. This one event was a huge chunk of the daily volume. So the core question for us is really this. Does DVLT's guidance for over $200 million in revenue for fiscal year 26, plus its, novel blockchain strategy, does that actually justify a massive forward valuation?
Or is the stock just so structurally compromised by dilution and this financial engineering that it's nothing more than a speculative trading vehicle constantly capped by insiders liquidating their shares? I'm going to argue that the acute fundamental risks, I'm talking disastrous gross margins, and the mechanics of the dilution, they cap any sustainable long-term upside, no matter what the revenue projections say.
I see why the focus is on those risks, but we need to understand why the company had to take such drastic measures. This transformation from WISA Technologies, a company already, scarred by hardware commoditization and saddled with a crushing $378 million accumulated deficit, this wasn't really a choice. It was a desperate, necessary move. They had to get into the high-margin world of data financialization. The current valuation is entirely forward-looking. If management actually hits its guidance of over $200 million in revenue, the forward price-to-sales ratio just plummets to an incredibly attractive 1.9 times. We're basing that on an effective, fully diluted market cap of about $385 million. A 1.9 PS for a company projecting this kind of growth in AI and data, well, that is fundamentally cheap. My bullish case is based on the core drivers here. The Data Science Division and the Information Data Exchange, the IDE, which is reportedly engaged with, over a dozen governments and corporations to tokenize trillions in real-world assets. The 148% revenue growth we saw in Q3 25, that supports the story.
That is a compelling story for the future, but I'm completely fixated on the structural reality that made it happen. The financial engineering they used was, it was immediately and catastrophically dilutive. We have to talk about the Skylex pre-funded warrant. It wasn't just a capital injection. It was a mechanism designed specifically to bypass standard ownership limits. The second it was exercised, the outstanding share count just exploded from roughly 86 million to over 350 million. That is an immense and immediate structural impairment for every single legacy shareholder. Any future revenue, no matter how strong, now has to be spread across 4 times as many shares. And the financials, they just confirm the deep operational rot they're trying to outrun. Just look at the Q3 2025 SEC filings.
Despite that 148% revenue growth you mentioned, their GAAP gross profit was only about $95,000 on $2.9 million in revenue. Do the math. That's a horrific gross margin of 3.2%. An AI and fintech company, supposedly, cannot credibly justify any valuation multiple when its margins look like a low-margin hardware distributor. That 3.2% is a screaming red flag.
I hear the alarm bells, and 3.2% is certainly a shocker, but it requires context. That figure is the cost of transforming a deeply distressed balance sheet while you're still carrying a low-margin legacy business. The $200 million guidance, that's not coming from selling more WISA chips. The real tension here, the thing we need to address, is whether that $200 million guidance is even credible, given that awful starting point.
Exactly. So if the revenue is transaction-based, what concrete, verifiable evidence do we have that suggests the margins are going to expand to the 60 to 80% range they need to justify an AI or data valuation? Right now, the trailing 12 months PS ratio is astronomical, 74 times sales. I mean, for perspective, C3 AI, a pure-play AI stock, trades at 6 times sales. So the market is valuing their past performance as more than 10 times more expensive than C3 AI. If they don't fix the margin problem by Q4, the stock will collapse under its own weight. I don't care how strong the top line is.
I think you're misinterpreting that 74x TTMPS. The market understands the shift. That number just reflects the revenue from the basically defunct WISA business. The fact that the forward PS drops to 1.9 shows the market is completely tossing out the last 12 months of legacy garbage. They are only valuing the future $200 million stream. And this projection is based on transactional volume percentages from their high-margin ID platform, the Information Data Exchange. This is where the RWA tokenization comes in. See, DVLT isn't building hardware. They're providing the rails and the patented licensing framework for huge institutions and governments to monetize their data. Their patents in blockchain-driven content licensing mean they earn transactional fees, access royalties. They're monetizing the data layer itself. That's where the 60 to 80% margin comes from.
The low margin right now is just a temporary artifact of the transition, not a permanent feature of the new model.
Okay, that's a strong theoretical defense, but I am not buying the margin expansion argument until I see it in black and white in the filings. Until then, it's just speculation built on top of desperate debt relief. But let's move to the most pressing structural risk, because this is what's dictating the market mechanics right now, the Silex dynamic. You call them a partner, but I see them as the executioner.
Well, I come at it from a different way. We have to acknowledge the capital injection Silex provided, $150 million paid entirely in Bitcoin. That capital was a crucial lifeline against immediate insolvency, considering DVLT had, $1.68 million in cash as of Q3 25. This deal saved the company. And the operational partnership is real. They have a licensing agreement for pharmaceutical AI tech with milestone payments up to $2.55 billion. This is the bet on the long-term success of DVLT's AI.
That's a fair point on the capital injection, but it totally skirts the issue of why they structured the deal for maximum immediate dilution. Let's just be clear for everyone listening. They used a pre-funded warrant, a very specific tool, precisely to get around beneficial ownership blockers, which normally limit how much of a company one entity can just buy up quickly. They used it to get a massive controlling stake instantly. So why the urgency, if not to convert that ownership right into cash? The massive size and speed of the December sell-off, 20 million shares dumped in 4 days, proves Silex sees DVLT stock purely as a cash equivalent. They're the ultimate wet blanket. Any attempt by retail traders to start a squeeze or a rally gets hit by a colossal wall of supply from Silex. And the overhang is immense. They still hold 244 million shares, just ready to be sold into any sign of upward movement. That structural reality just perpetually caps the stock's upside.
I acknowledge the massive overhang is a serious psychological and structural hurdle. I do. However, the company has been extraordinarily aggressive and, sophisticated in engaging the retail base that drives the volume, which brings us to their highly unusual dividend strategy. This is where the complexity of Web 3.0 valuation models really intersects with traditional finance.
This is maybe the most audacious part of the entire thing. I question the fundamental regulatory basis of this conditional warrant dividend structure. 1 warrant per 60 shares, $5 strike price. The key element is this gatekeeper mechanism. You can only exercise that warrant if you possess a Dream Bowl Meme Coin 2 token, which has to be in a Data Vault digital wallet. I mean, we have to be clear, this is not standard corporate finance. This blurs all kinds of regulatory lines, especially around the Howey test. The company can call the token a non-financial collectible all they want, but by linking a clear financial instrument, the warrant, to owning the token, they are creating a massive regulatory lightning rod.
I'm not convinced that focusing just on the regulatory risk captures the strategic genius behind it. This is sophisticated, forced utility, and it's designed specifically to enhance their valuation in the Web 3.0 space. The primary goal here is to inflate the active wallet metric. In the world of blockchain and DeFi, that metric is a key multiplier for valuation. By forcing thousands of retail shareholders who want the option value of that warrant to download the Data Vault wallet and get the token, the company can legitimately report massive user growth and active platform adoption. The out-of-the-money warrant provides the option value, or gamma, which gives retail a reason to hold the stock through the record date and adopt the platform. It creates the loyal, sticky base they need to achieve the bull case, which targets $4. It's an incredibly calculated way to use financial structure to drive platform adoption, turning speculators into actual users.
Calculated, maybe, but they're gambling with the SEC. Let's just think about the Howey test for a second. The test asks if there's an investment of money, an expectation of profit, a common enterprise, and if profit comes from the efforts of others. If the token is necessary to get a financial return, the warrant, an investor could easily argue the token itself is the investment. They are walking a very tight rope. If the SEC investigates this as an unregistered security offering, the whole thesis collapses. Instantly. The risk here is binary. It could send the stock straight to zero.
That risk has to be factored in, but if the alternative was going broke, then management had to be aggressive. My point is still that the market is focusing on the future and management is using every tool they have, no matter how exotic, to build a base big enough to handle the massive share count. The fact that the stock has held up at these levels after the Silex liquidation shows the market has some faith. We should also note the high sell-off risk on or right after the January 7th record date, once traders have their tokens and warrants. That suggests a pullback, but it doesn't kill the long-term thesis.
That January 7th risk is a perfect example of how this stock is defined by trading mechanics, not fundamentals. The Silex overhang alone ensures that rallies are temporary. The only reason the stock is held on is the retail excitement around this gamified dividend.
Ultimately, the core investment decision hinges entirely on the credibility of that $200 million revenue guidance and the margin expansion they need to back it up. If that $200 million figure materializes through the high-margin ID platform, and we have to assume management is confident to put out that number, then the stock is simply massively undervalued right here. The risks we've talked about, the legacy margins, the Silex dilution, they become transient consequences of a necessary aggressive pivot. At 1.9 times forward sales, the upside is substantial and it justifies the risk.
But that's a bet built on projected perfection. The reality is, the stock currently trades at 74 times sales. It has a 3.2% gross margin, and it faces this immense structural overhang from Silex's 244 million shares. The potential 5x upside is a lottery ticket, and it's heavily dependent on regulators looking the other way and an unprecedented margin expansion. The common stock carries acute and immediate sell-off risks, proven by the fact that their biggest investors sold 20 million shares the second they could. It is a trading vehicle defined by extreme volatility and structural impairment, not a fundamentally sound investment.
It's clear we still fundamentally disagree on whether these risks are transient or permanent. Valuing a company that blends deeply distressed legacy tech, aggressive financial engineering, and speculative Web 3.0 elements is, well, it's profoundly complex.
Absolutely. And the future scrutiny of gross margin expansion, specifically what Q4 earnings show us about the IDE platform, that will truly be the definitive arbiter of whether this is a transformative growth story or just a highly engineered liquidation event. Until we see that margin expansion in the numbers, the fundamental risks are still the dominant fact.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.